Mauricio, what were the guesses for AJ's name?
Dude, I almost forgot that we did that. But yeah, so there's like a bunch of comments. They were like Anthony James, which is cool. Apollo Juice.
Nice.
Alfred James. Anthony Joseph. And then the real name, which, I can't say.
Alejandro Javier.
Oh, I'd be so much hotter if that was my name.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 98 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband. The gang's all together. We took a little hiatus there for a week. Sorry, guys. Couldn't get our shit together. But we're back.
We couldn't get our shit together. I was sick. What do you mean we couldn't get our shit together? I was trying to be nice.
Mauricio couldn't get his shit together.
I couldn't. Dude, you guys backed me up here. I was sick and,
We'll back you up. How do we know if you were actually sick? You were only texting us. It's not like you sent us the COVID test.
I was actually Turks and Caicos is where I really was.
Yeah. Well, no. So you were sick, and the problem is that we kind of had a weak lineup of what we were going to do, and you were supposed to be leading like our main event. So then we were like, we can't do it without him. So then let's push it till tomorrow. But then AJ couldn't do tomorrow, and so we just kind of scrapped it.
Why do you say it's a weak lineup when I was doing the main thing? It was like going to be one of the best episodes ever.
Ever. Well, I'm not going to start with you anyway. I'm going to start with Jay just because I want to put him on the spot in the middle of eating. How's it going, Jay?
You caught me with a mouthful of food. It is going well. So we had an extra week to prepare for this episode, and we still waited to the last minute. So I think I'm still preparing for today.
Well, you better. We rely on you, Jay, to kick us off. Actually, you're not starting this week, so suck it. What are you drinking this week?
I needed a little pick me up. I'm exhausted. I was traveling for like 48 hours up north. We did like a plane flight up in the middle of the night, came back in the middle of the night. So I'm exhausted. So I needed some coffee. So I went with a big cup of coffee and threw in some Kahlua to make it extra yummy. Not Costco.
I need to introduce you to this thing called Red Bull vodka. It does.
Yeah, trust me, Red Bull sounds really, really good right now. I wish I had one.
Yeah, that was used to be when I was all over the world playing hockey. That was like the 1 a.m. thing. If you wanted to get that extra 2 hours out of your night, like you cracked the Red Bull vodka and it kept you going. AJ, how's it going, man?
It's going pretty good. I got my red cup with some Fountain Diet Coke, as per usual. So I'm feeling good.
Nice. Ernie's chilling. Ernie's got, what's that, an orange light behind him now?
Yep. Yeah. Orange today. Got a nice little reflection there, huh, buddy?
Switching it up. Mauricio, what's up, man?
Dude, I got so many announcements to say. So
that's why I left you to last. I was like, I didn't want people to get annoyed.
I'm drinking my favorite. I just realized how this has really gotten expensive. It's creeping up to the next level now. But I'm drinking my favorite Lewis Mason Cab, one of my favorite go-to wines. Not a daily wine, but maybe a weekly wine or a bi-weekly wine. So that's a big thing. Another big announcement is I finally retired the Nutcracker that has been sitting behind me since Christmas or before Christmas. It's officially come down. And then totally forgot, but 2 weeks ago, we had a contest to win this book, Tax-Free Wealth, autographed copy of Tax-Free Wealth to the person, there you go, those of you watching it on YouTube, person who could guess AJ's real name. And you guys heard some of those in the intro, but we had 3 people guess right. AJ, what is your real name, buddy?
Austin James Osborne. So, Austin James. And we got to look at the timestamp to see.
No. I did it differently, and I did it differently. So there was 3 people, Steven, Kurt, and Business Engineered, who got it right. And so I went with I hope I'm not breaking any laws here. I'm not sure if this is legal or not. But I just decided to ask ChatGPT to randomly select one of the winners, and ChatGPT selected Kurt. So Kurt Muller, congratulations. I will reach out to me or I'll connect with you. I'll get you the mailing address. I will mail this book free of charge. And for those of you who are not sure, I will put in the comments a screenshot of ChatGPT, because I know there's some people that think this is all rigged and it's really Jay pulling the strings behind the thing.
Well, here I'm gonna add to the conspiracy theory here. I think I'll have to go back and check. I think it was Kurt that guessed my body fat percentage a couple months ago.
Interesting.
And won a DRE mug.
Interesting.
So
Interesting.
Kurt's killing it.
Yeah,
Kurt,
geez.
let's see if Kurt can go for a triple. I'm not sure why he won two. I've got another one of these. I got to get rid of these for reasons I'll say at later dates. Tax-free wealth, autograph copy, Tom Wheelwright. You've got to guess. For those of you who didn't know, a little tidbit here. Jay Scott used to be I'm going to call him a semi-pro or pro? What would you call yourself? A semi-pro?
I mean, I had a full-time job at the time. So,
all right, so that's he used to be a semi-professional poker player. And one of the years he made it to the final table of the World Series of Poker, believe it or not. And so the question this week.
Let's be clear, not the main event.
That's right, not the main event. That's what the question is. What event did he make it to the final table of the World Series of Poker? Was it like, no limit, Omaha, 7-card stud? What discipline did he make it? And I guarantee you're not going to find it on the internet. So you're going to have to guess, or if you know, drop a comment on the YouTube, and we'll pick the winners next week. If I'm not in jail, I'll probably use ChatGPT again. Get your copy of Tax-Free Wealth from my buddy Tom
Extra
Moore.
credit. How well did I do at the final table?
Beaten by a pair of jacks?
All right, let's get the show on the road.
Is that all we got? Einhorn is Finkel. Finkel is Einhorn. All right, let's get into this. We got a couple meaty topics to go into, starting with, it's been a rough couple weeks for the debt markets. It started with Moody's downgrade of U.S. credit, which was followed by historically low demand during a U.S. 20-year Treasury auction. And for the most part, this debt volatility has been shaking out in the long end of the curve, but the 30-year and then the 20-year. So theoretically, the 10 years next, right? That's how it works. 30, then 20, then 10. And that would suck because 10 years, what we really care about as real estate investors. So AJ, why don't you kind of dive in a little bit? What's going on in the debt markets right now? And should we be starting to get a little bit worried about where this is going?
Well, I freaking hope somebody would get worried, because the United States hasn't been worried for a long time. So we, obviously been talking about this a lot, and there's a reoccurring theme that has been going on over the last, really, I think, kind of two presidencies. The first Trump, and then Biden, and then going into now, just as a time frame basis. But
let's be clear, we can't put all the blame on those guys. Obama takes a lot of blame. The first or the last Bush
started in 2008. Bush and Obama kicked this all off, and it's been something that we had in the United States. There was a thought process that really took hold during that time, and that thought process got embedded deep within the system. And that was from the Fed all the way to the government. And this thought process was that because we are the world's reserve currency, we can play these games that basically meant we could just keep printing and we could keep borrowing. And in effect, because it is a Ponzi scheme, it's one that we rig and will never end. And this thought process really, really took roots. And this is, you need to understand the way that they think about it, because it is a way that the government interacts with the economy. And that's why it's an important point. And that was that this hands-off approach of the government and the economy being separate, that could go away. In fact, that needed to go away. And that the government should, in fact, a lot of people thought that the government had almost this moral obligation to play a much larger role in the economy. And during 2008, that was the theme. It was capitalism failed, the banks went bust, the government stepped in, we need to bail out the banks, we need to play a much bigger role in the economy. And that is where the United States shifted to. In a
modern monetary theory was born.
That's correct. And this monetary theory, which is that the government should play an equal role, basically, in the economy, it has always been around. That's something that it hasn't not. But it had never been around like this. it really took hold. I mean, we literally took over the banking system. It was really, really a big deal. And even worse, it worked. So in 2008, what had happened was we had a credit crisis. Credit crisis meant the credit or the money in the system just evaporated. The government stepped in to fill in that hole. So the economy lost money. We had deflation, right? Everybody was selling everything because its value kept dropping. Money was worth more than assets and everything else were. So they wanted money. They took it all in. So because money evaporated. So it had gotten scarce. The government stepped in. They inflated things by printing lots of money to fill in that hole. And by doing so, they stabilized the system through both the Fed and the government, all sorts of forms of QE, taking on bad debt. And so the balance sheet grew. They actually printed money, direct money. They stabilized banks. They became basically the creditor of the system. And they filled in this hole that had been lost. So when COVID came around,
and just for those watching on YouTube, I put up here a quick chart of the M2 money supply. This is basically the currency that's in supply in the economy at any given time. And for anybody watching, you'll see we saw kind of a consistent run up from 1990 to about 2020, and then we just skyrocketed after 2020. Lots of extra money has been put into the system.
It didn't do very much in 08. And the reason it didn't do very much in 08 was because credit was lost. So like when you look at it, you're going, how in the world did the government print $1 trillion and yet the M2 money supply didn't grow, right? Well, that is why we didn't have inflation. So
and here's the other thing that happened in 2008. That money was put into the economy through the banks. The government handed the banks a bunch of reserves and said, lend this money out. And a lot of people didn't qualify for credit. So a lot of that money literally just stayed on the balance sheet of the banks, never got loaned out, never entered into the economy. 2020 was completely different. 2020 was so bad that we were literally helicoptering people money, sending them checks because we needed to make sure people were eating and paying their rent.
We
and
didn't
all
lose
those
any
things.
money. So like there was no,
and we didn't lose any money.
You, in order for that to work, you have to actually have a loss of money. So in order to not create a major issue, so we were at the end of a credit cycle, a short-term credit cycle when COVID hit. We had actually been leveraging up, like that chart that Jay showed. The M2 money supply had been growing very, very strong. We're at the top of a money expansion cycle. Why? Because as people were able to take on more debt, assets recovered after 2008, houses' assets began to get more, people had lots of cash, they started leveraging more, then COVID hit. But we didn't lose anything. Instead, we poured trillions of dollars into a system that already had money, and that money was already expanding, i.e., the banks were flush, and people could take that money and they could borrow it. That's not like throwing gas on the fire. That's like throwing a nuclear bomb on the fire, because every dollar that went into the system multiplied by, 100 times. In COVID, what Jay was saying, they filled in that hole, but there was nothing else to do with it because the system couldn't continue. It couldn't leverage it out because the system was so broken and failed. So what it did is it created a stabilization point that we could grow off of. Well, that's the lesson that they learned. And so politicians, because they're stupid, thought it's the exact same thing. And so what did they do? They just poured money into the system. That erupted. M2 supply grew dramatically, which caused inflation. Then inflation came around. So what did they do? They had to increase interest rates. Interest rates, when you increase them, shrinks the money supply. It puts us into a recession.
You say because they're stupid. Like I think they're just reacting. Like they don't even think that next step ahead. They don't correlate it with anything. They just say, "Oh, we need this, we need that," and they just do it. And then they all get on board because our constituents right now need money. Let's give them some money. How are we going to give them money? Like that's as far as they think.
They don't think about it. There's not a forethought to it. It's just they all worry about their own people and how to maximize it. Then everybody maximizes it, and money goes everywhere. And when this is happening, as we got inflation, in order to get inflation down, you need deflation, i.e., you need money to be lost. Money lost means we need people to go bankrupt and you need people to lose their jobs. Now, everybody hates hearing that, and nobody hates it more than politicians. But you actually need the economy to go down. Like that is, if you put too much money in it, you need that to go away. So the problem is you created the problem. Now you have to get rid of that. It's really easy to put $5 trillion into the economy like that. Getting it out is not easy. But politicians also did not want the repercussions of a recession, which is they get fired. So if there's a recession, politicians are out. So the government instead offset the high interest rates with borrowing money. And in effect, the government stepped in and became the Fed lower rates. They injected trillions and trillions of dollars, $4 trillion a year. That offset any of the effective interest rates. We didn't have economy. The economy didn't go down. High interest rates, high inflation, lots of money. This borrowing effect was just crazy, right? It was insane. But the economy was going up. And we still had QE and the leftovers from COVID, which allowed that to continue. Now, as we step into this year, we were promised, oh, you're going to have Anastery, all the politicians, of course, which they're politicians that don't do it. When we looked and they started to, how the government gets money, everybody, the government goes to the Fed, right? We issue T-bills, so we have to borrow it from people. That if you don't have enough people that want it, you have to entice people to take the assets. Interest rates have to go up. So everybody's like, well, I'm not going to give you that at 2% because I have lots of other options. I can put it in the stock market, or I just don't trust the government. Well, what if we give it to you at 6%? Okay, I'll take that. So if the government gets it at 3 or 4%, then it goes into the banking system, then it's higher than that. So rising interest rates is encouraging people to come buy those bonds. That's what they're trying to do. Now, where we got here, though, is a problem because it was fake. And this is what everybody missed. It's what we've seen in the bond market, interest rates staying higher, which we've talked about on this podcast. We're like, yeah, I don't think interest rates are going anywhere this year. And it has a reflection of investors in the market that don't want to buy bonds. But here's the big but, though. That can be warped. So we have mechanisms in place. So why are interest rates going high? And why aren't we using those mechanisms to just lower interest rates? At the same time, the Fed decided to do something else that had not been done if ever having an issuance of bonds at this level. So I don't think this is necessarily systemic, and I think it will be more of a short-term problem, but the Fed lowered its balance sheet. So at the same time they were issuing, we have now gone through a period of how many months where the Fed was taking off the trillions and trillions and trillions of dollars of bonds that it had. So we have had in a 6-8 month period, one of the largest bond, because the Fed can do two things. They can roll over the bonds that they took. So the Fed's buying the debt, right? That's how they're warping the system, so to speak. All right, so Jay's showing a chart here, and this is the total assets held by the Fed. And as we can see, right at the end of 2023, when is that? Or 20
at the middle of 2022, they got up to about $9 trillion of basically money they injected into the system by buying assets.
And so they started selling these off. A huge portion of this $9 trillion, like it's 5, I think, of it is bonds. They started selling bonds off. So they are selling bonds. So the first 2 quarters
when you say selling, they just weren't rebuying them, right? So
they weren't rebuying them.
Yeah. So they originally bought these bonds. Those bonds expired, and instead of, as you said, rolling over and buying them again, they just let them expire.
They let them expire. They go to the market. So you are getting hit now 2 sides, not just the government, but also the Fed. At the same time, everyone, we around the world have all these countries and everybody else that are in the middle of they're issuing their own debts. So right now, the increase in interest rates is a reflection of a scare of 2 things. First of all, I do think it's with the United States standing, although I don't think the world's not betting on the US dollar. I don't think that's what's happening, but I think investors are showing limits where they're going, hold on here, right? We're kind of showing limits, but really we have two sellers. We have the government who's selling bonds to get debt, and we have the Fed that is lowering their balance sheet with bonds. And at a time when you're talking about $4 trillion, more than that, what is this bill, Jay? What is the spending bill? What are they trying to raise debt for right now?
They're going to raise the debt limit by $4 trillion.
By $4 trillion. So what's the total amount?
So right now we're running about a $2 trillion a year deficit, and that's another $400 billion a year. So 2.4 trillion.
Yeah, the $4 trillion is just for back pay, basically, right? Like
and it's a rolling thing. So as they're increasing the debt for the future ones, they're still taking money from the system. So it's like the stacking effect, right? And Jay will go into the spending and how they just love to blow money. But this stacking effect as it rolls up is rolling up right when we're reaching insane figures by the government and the Fed is unrolling it. Those two things.
Don't you think they're about to probably start buying them again? Like after that 20-year,
yep, I think so.
After that 20-year fiasco, what was the spread? Like it ended up being like 15 bips, and it was like the highest.
But nobody likes the 20-year. The 20-year is the redheaded stepchild. I can say that. So
agreed.
So,
but at the same time, it was an indicator. Like that was like one of the highest spreads in history. And the easiest way for the Fed to counteract that is to just, okay, once it gets to 5, they start buying it themselves, right?
Yes. And
yeah,
I do think that's
back. Let me just push back a little bit on that, because you got, again, as always, everyone gives the Fed a little bit more power or credit or whatever you want to call it. But again, don't forget that the bond market that AJ done such a great job explaining. This is a global market. This is not just US. This is like, it's the global. It's the deepest market in the world. So yes, if the Fed is selling and the government is issuing, then yes, that means that the demand for these things are lower and so forth. So there's a supply and demand imbalance. But remember, there's like countries all over. Japan's been in the news again. We talked about the Japanese yen carry trade. I don't know how many episodes ago, but that's starting to unwind again. And so now
doesn't Japan own like 90% of their own bonds or something crazy like that?
But they also have a ton of treasuries, and so if they need to get access to the yen to defend their currency, they're going to sell the treasuries that they have. That doesn't mean that they like treasuries or don't like. They just need their own yen. They've got the reserves in treasuries, so they can sell those treasuries to get their yen. That puts downward pressure on the bond market, which increases it. So there's a lot of
random question, by the way. Who the f- is buying Japanese bonds other than the Japanese government? Like, is it just like who owns that 10%?
A lot of people were up until a couple of weeks ago,
and everybody stopped
just for the carry trade, like for for that. Like, what other reason? Like, it's half the rate of the U.S. bond and more risky. So, like, what? Like,
people were looking for a safe haven outside of U.S. bonds. People, for some reason, thought Japan was somewhat safe, so they were moving a lot of money into Japan.
Half the rate?
Yeah, half the rate. Now they're moving it to Germany. Germany's that new safe haven. So people are
not even a safe haven. They're so small compared to the U.S. Like they're teeny. Like this, like you have the carry trade and you have like a few other things going on, but these are a lot of these are short-term blips. And I don't think that they mean that people think that Germany or Japan is safer than the U.S. because it's teeny. It's like a mom and pop store compared to Microsoft and looking at the prices, right, of them.
Yeah, but they are short term, and that's why if you're looking at the 10-year, for example, you're going from like 4.6%, then it went all the way down to 3.6, then it went all the way up to 4.8, then it went down. I mean, it's also going up and down depending on what's going in the dynamics of the world economy. So as countries sell, and then suddenly, oh crap, something else. Now I'm going to start buying, or I'm going to buy gold, and so I'm going to sell some of my treasury to get gold. Like it's a global market, and so focusing too much on. Like if you compare the amount of issuances of the U.S. government versus how much buying and selling is going around in the world economy, it's pittance, right? The Fed, yes, the Fed is a big player, but there's also all the other central banks around the world. Like the Fed's obviously a big player, but when you consider the 100 and something other central banks around the world that are buying and selling these things, I mean, it's a factor, but I just don't want to emphasize that they have complete control, that suddenly the Fed pulls a lever here.
But at the same time, for these treasury auctions, though, they can step in and be basically the last resort. And if they start to see this happen again, where it becomes a typical spread's what, like 3. Like you could see a movement of like 3 one way or another during an auction. So if it starts getting over 5, they could step in and kind of during the auction stabilize it and stop the run up and stop people panicking.
Look, here's the high level takeaway here. The interest rates are driven by these bond yields. Bond yields are driven by supply and demand. And so what we have to be looking at is what's happening with supply and demand. We all know, not all know, but we've heard a lot over the last couple months that maybe there's less appetite for U.S. debt right now because of the trade war, because of the downgrade in credit, whatever, Japan's selling, whatever. So there's thought that there's less demand out there. And so that's what a lot of people have been talking about, and that's what's been driving a lot of concern over the last few weeks, that there's just not a lot of demand for U.S. bonds. The bigger issue that I see is not on the demand side, but it's on the supply side. So right now we're running a deficit of $2 trillion a year. It was $1.8 trillion last year. It'll probably be $2 trillion this year. So that's $2 trillion of new bonds that we have to issue to raise that money to keep the country running. But on top of that $2 trillion sounds like a lot of money. We're going to talk about the House spending bill, which is going to increase that to closer to $2.5 trillion every year. But still, that pales in comparison to the fact that we have $9 trillion of bonds that are expiring this year that need to be essentially refinanced. Basically, we need to resell that debt because those bonds are coming to the end of their term. So that $2.5 trillion a year is a huge number, but it pales in comparison to the $9.2 trillion additional bonds that we need to sell this year just to re-up or refinance the bonds that are expiring. That's about $170 billion a week. $170 billion a week,
including the Fed lowering its,
and that doesn't include the Fed not buying as much and selling off.
It's a 100% supply problem. In fact, I would argue, and I'm going to, demand has never been higher because that is unarguable. It's true because we've never seen the purchase of bonds like this ever. I mean, the amount that we are currently buying that the market is taking in is astronomical. But the problem is, when do you hit that limit where it's like, everybody's like, okay, I'd love to buy more. I literally can't. There's only so much that you can buy, right? So right now we're consuming bonds at levels never recorded. So to say even that people don't want American bonds as much as they did like 20, 30 years ago is ridiculous because we're buying more they're literally selling more in a month than they did in an entire year. So we're consuming at rates way more, but there's only so much appetite. We can only rig the system so much. And I think what Jay's saying is correct. We're coming up on the limits here where it's like, there's not going to be buyers. There can't be.
So let's talk about coming up on the limits. I want to kind of change gears a little bit because I think another really important question that we should be talking about is, are we necessarily on a crash course with disaster? Are we necessarily coming up towards a cliff? We know debt was 28 trillion 10 years ago. Now it's 36, 37 trillion. It's likely to be 40 trillion in a year or two. Those are big numbers. But is 40 trillion really that much different than 28 trillion or 10 trillion? Obviously, it's a lot more. But at what point do we really think like we're going off the rails? And here's the thing that we have to consider. A lot of really smart economists have asked themselves this question and have written about this idea of, is bigger debt necessarily going to sink this ship of the USA? And what they found is there's essentially 3 things that matter when we try and answer the question of, is this debt going to crush us? Number 1, growth. So GDP, how much the economy is growing every year. Number 2, debt. So how much we're going into debt every year. Obviously, more growth is better, more debt is worse. And then the third is interest rates. So are interest rates going up or down? Higher interest rates are obviously worse because we have to pay debt service on that debt. And so the two big questions we care about are, 1, are we growing faster than we're going into debt? So right now we're growing at somewhere around $1.5 trillion a year. Our GDP is going up somewhere around $1.5 trillion a year, best case. It's probably closer to $1 trillion a year over the last 6, 7, 8 years, but 1 to 1.5 trillion. We're going into debt, as we discussed, to $2.5 trillion a year. So one, our debt's growing faster than our GDP, our growth. And then number two, and two really famous economists, Larry Summers, Jason Furman, well-respected economists. They had some really bad timing, but back in 2019, they wrote a paper about how don't worry about the debt as long as growth is higher than interest rates. And at the time it was. Interest rates were really low and growth was doing real. We were at 3% growth.
They're my favorite Keynesians by far.
Yeah. Yep. Yeah, but there's a lot of data and math behind the idea that as long as growth is outpacing interest rates, you're not going to grow debt to GDP. You're going to grow debt, but you're going to maintain debt to GDP. You're going to maintain your interest payments, and you're not going to go bankrupt. And so in 2019, when they wrote
the idea that eventually there's some magic debt to GDP that causes it to collapse, right? We have no idea what it is, but
in theory, it doesn't go up as long as growth is growing faster than debt, and growth rate is higher than interest rates. As long as those two things are true, our debt to GDP isn't going up, and all things are good. The problem is when they wrote this paper in 2019, they ignored the very real possibility that 3-4 years later, we were going to see really high interest rates and relatively low growth. And so we're now in a situation where debt is growing faster than the economy, and where interest rates are higher than the growth rate. And those are the two things that if those continue, we're heading towards a cliff. And so the way we get out of this is lower interest rates or higher growth or less debt. Those are the three levers that we have to pull here. And right now, there's no appetite from either the current administration, the previous administration, or even the last two before then to do any of those three things or have the ability to do any of those three things.
Well, it's not even the administration. The administration doesn't control it. It's Congress. And so when you look at this, the problem with these guys, Keynesian thought process, all of them, which they've been preaching since 2008. It was the government should play more of a role, take on more of that, and it's okay because we have growth, right? Like Jay's saying. And these figures, what they all failed to realize, which is ridiculous because they get in these mind traps where they're all reading books and don't do anything, that when you take $1 out of the economy and it comes from the government, you also take $1 from the economy and it stops multiplying like it used to because the source of the dollar matters in the economy, not just the dollar. So what happens is you inevitably are eroding away the very things that give you growth. So if you're growing, right, and you can keep it under growth, but as you play more of a role in the functionality, so we can expand our debt, we can expand the role, we can take on all of these aspects. We can do military, we can do healthcare, we can do everything. The very production of the thing that you're taking over is no longer there. And you're betting on all these other things to happen, that everything goes perfect, and you'll never have a hiccup, and that other industries will offset it. They'll never come down. And if everything works out magically perfect, we can erode away this production and the means of that the source of that money creation, and the government can play this role in it. And it fails, obviously. It's a stupid notion because what did we see? The more that the government plays a role, the more debt. And what debt means is the more, not like the debt payments, the more dollars that the economy is leveraged off of and using that come from the government, not production, the more future production is eroded away. And so as our government debt has gone up, guess what has gone down? Production. At this point, still, the figure of the total amount of dollars that are in some way connected to our government is got to be 50+% because of how money is leveraged within the system. And so this effect is leveraged on both ends, just like it is anybody's personal. But once you realize that, it's too late because it's not that you just borrow money. Once you borrow money and it goes into effect, it becomes the economy. So this is why nobody wants to do it. Because if you stop spending right now, What would happen if they just cut $2 trillion, $3 trillion out of the budget? You cut $3 trillion out of the economy. It's bad.
But I guess there's zero incentive for anyone to fix it is the problem.
Not until they have to. Anesthesia is always by force with governments.
There's no agreed upon level at which this is unsustainable. I remember when
it's a problem.
When we were going to hit the 100% debt to GDP, everyone was freaking out. Like, oh, we can't go over 100%. We can't go over 100%. It's going to be the end. Like, that was a long time ago. And what's it going to be, like 200% that everyone's going to freak out again? Then we'll probably blow past that.
Why is that the right? I always hear that. And I always, first of all, if you look at the debt to GDP, everybody says once you get to 100, 120, you're kind of in deep doo-doo, which we're already, remember our debt is 36 trillion. Our GDP is about 30. So we're already over 100%. But you look at a country like Japan, they've got like 200 plus debt to GDP. And I haven't been to Japan, but I don't feel like Japan, they keep saying it's not doing as great as it could be, but I don't feel like if you're in Japan that you're suddenly going through some magical thing. The one I've always paid attention to is what is the interest payment, like your deficit as a percentage of your revenue. Like that to me is more like, think of your own personal economy. And I know the government's not, it's different obviously than a personal economy, but if you're like, how much debt, how much is your monthly credit card payment? Like how much is coming out versus how much income do you make? Like, and as that number starts creeping up, and we're like at 30%, like 30 cents of every dollar that we make has to go to pay the interest on the debt.
You just said the point of failure. The reason being is what everybody needs to realize. Once you get to that point of failure, guess what happens? Your ability to get cheap debt goes away. So once everybody realizes our expenditure on interest is so high that it's actually making it harder for us to do things, that makes your interest rates go higher because now people don't believe in it. So it is a self-perpetuating thing. And this is what you talk about when you're talking about debt crisis. They come out of seemingly nowhere, but it's when all of a sudden the very nature of the machine that provides the money is in question. So the machine that provides the money makes it more expensive. So every dollar gets more expensive.
I feel like people have been questioning it for a while. So why now? I guess is the question.
Because the market is questioning it. The bond market isn't. That's why I think really people started to get scared was because the bond market all of a sudden didn't seem like it had as much of an appetite to buy them.
But I guess what was the catalyst for that? Like, the timing with the Moody's thing and like that Moody's thing, like was a nothing burger. But
it has nothing to do with Moody's. It has nothing to do with tariffs. I think it has everything to do with the issuance. We were depleting. We have two major drivers. We have debt, but then you also have the Fed that's reducing its balance sheet. So let's say they're going out for $3 trillion. The Fed's lowering its balance sheet by $5 trillion of treasuries. You're talking about doubling, right? So when you look at that, it's not just what you see on the market. So the market has way more issuance.
Quick comment on the Moody's thing, though, real quick on the Moody's. Like, ever since 2008, the fact that anybody even listens to Moody or Finch or any of these credit ratings, these are the same companies that were putting AAA rated scores on these corporate, all of these mortgage-backed security. They're getting paid by the people they're rating. I mean, I don't understand why anybody even listens to these guys, but
and they
I think
it's from debt, but they didn't do it last year. So then you got
you want to know a fun fact? So it was 2011, right? That Fitch did the downgrade. And do you know what happened to treasuries? Demand went.
It actually went down.
Yes,
yeah, they went
exactly.
to reverse.
Demand went up last time because it was volatility in the market, it was uncertainty in the market, and people ran to treasuries. So it would the whole rating thing is it was literally people. I think people watched last time and how it was a buy the dip opportunity last time where there was a bit of a dip and then all of a sudden it roared back. So it didn't take much of a dip for everyone to just jump back in and try and capitalize on buying the dip.
To wrap it all up, I think to answer your question, Kyle, it's like, at what point is it? I mean, it is a game of confidence. And I feel like you've got this house of cards, basically, that when it gets to the point where everybody's like, oh crap, which again, the amount of, as a percentage of our revenue, how much we're spending on interest payments alone, where we're basically at the point where we're having to borrow money to pay the interest. you get to the point where
But
people
we've known about that for a while, though, and interest rates have been high for a while. So, like, why now?
But you can borrow at free money, 2%. So you're borrowing at under inflation rate. So what happens is that's why it's the tipping point. Once you can no longer get free money and it costs you, and then you say we can't pay the cost, money gets more expensive. And then you have
Is this just the realization, though, that interest rates aren't coming down? And so since interest rates aren't coming down, we're not going to be able to refi this debt out, and that our debt burden's going to be just stay high for long enough that this could end
It'll be over $1 trillion. Our interest payment will be over $1 trillion a year in a company that barely gets $3 trillion in revenue.
Here's I don't think we have time to talk about this, but I'm going to throw out an interesting thought to you guys. At this point, everybody's talking about the U.S. having to issue a lot of short-term, or should be issuing a lot of short-term bonds, basically to bridge the gap at this high interest rate environment, basically get us a couple years down the road, issue 1, 2, 3, 5-year bonds in the hopes that interest rates are going to be lower in a couple years and we can refinance at lower rates.
Because the long end is like, why would you issue the long end ones? They're higher, right?
Well, they are, but here's the countervailing thought there, and that's, if we're heading into a high interest rate environment over the next decade or two, might it be better to lock in these 5.25% interest rates at the long end, the 10, 20, 30-year bonds, so that if we're likely going to end up in a high interest environment in the next few years where bond rates go even higher than they are now, we might look back in 5 or 10 years and wish we had locked in at 5%, is my point.
Like we did with the Obama administration. Like, if we hindsight's 2020. So, but if we could look back and go, we had it at 1%, we should have locked in for.
We had 0% during COVID. We should have done it then too. Yeah,
Well, I think that's what wasn't Trump talking about, issuing 100-year bonds back then when interest rates were at 0. It just never happened, right? Just never happened.
Yep, would have been.
I have one chart I want to show you guys too, because you guys are going to think this is funny. I think this is a funny chart because you start thinking about it, and for everybody, I'll explain it, so don't worry. But that's listening. Okay, so you start thinking about this game that we play, which is the great Ponzi scheme, right? What I'm showing you here is this is U.S. Treasury interest, okay? So on the one side, this is the beginning of the 2020. So we're a year and a half off these numbers. So it's actually higher than $1 trillion, right? It's like 1.3 or whatever. But the total taxpayer cost, right? Say right around 1 trillion. The government trust funds, which are things like Social Security, everything else like that, they make $480 billion a year in interest payments. And private citizens and institutions in the United States make $400 billion a year in interest payments that receive, yes. Trust funds and of the government and private citizens. Of the $952 billion that the same Americans that receive them are paying. And
we're basically funneling money to the people that own bonds.
Yep. And so this is why, too, debt and government spending, it has this separation effect in society where government spending makes the rich richer and it makes everybody else poor. So asset holders get a leveraged wealth effect while taxpayers get destroyed. Government spending always does this. And this is one of the reasons why I don't know why I think that's funny. I'm like, oh, here's what Americans have to pay. And here's what they're giving back to themselves. Like, come on.
Yep. Yeah, we really are. We're funneling taxpayer dollars to the wealthy, those who have.
Let me throw up one last screen before we move on, and I'm hoping maybe actually one of you guys could explain this to me. But we talked about this before a few times before, the term SOFR curve. So anybody who's in commercial real estate really cares about the term SOFR curve because it's the forward projection of what term SOFR is going to be. So if you have a floating rate loan, this will be one of the main things this is based off of. And if you look at the tail of this, the tail of this just takes off. So you could see in the beginning of the SOFR curve, and this actually has the Fed dot plot on here. It stays with the dot plot till about the end of this year. And then all of a sudden, the 1 more month term SOFR projection just takes off and then runs up for the next 10 years up to over basically what it is now. So that's interesting in itself. Just like I've never seen that kind of run up.
What is that telling you, Kyle? That the market doesn't believe that the Fed is able to or will be reducing?
Well, you can see it right here. If you follow the dot plot, if you go to 1 year after that, so December 2027, you could see that the Fed dot plot has a projection of 3.25, but the market's saying, no, that's going to be 3.5. And then if you go out 2 years, then it gets even worse, where the Fed dot plot says 3 and the market says 3.6.
So the market's not believing the Fed, obviously, because if the market believed the Fed, they would be.
But what's crazy to me now is if you put the 10-year Treasury on this. So if you overlay the 10-year Treasury and look at this, so the 10-year Treasury is currently let's just call it even at 4.5. Look at what the projection is for where the 10-year Treasury is going to head. It's just basically up and to the right, to the point where the 10-year Treasury in 10 years from now, the projection is almost 6%. So, like, to me, explain this to me. If this is actually why would you buy if you're just doing a Treasury as an investment? If the Treasury is projected just to go up and up and up and up at the 10-year Treasury, like, that means the value of any 10-year Treasuries you're owning right now is going to go down, down, down. So, like,
which is why you're not going to buy a 10-year if you think at 5%, if you think inflation is going to be 5.5% and the 10-year is going to get to 5.5%.
Well, I just thought this was interesting because it kind of shows what the long end of the curve is doing right now, because this 10-year has to kind of, the curve has to just fit what the market's telling, and it has to fit what's showing on the long end of the curve for the 20 and the 30 and the stuff like that. And the fact that it's heading this way up is indicating that there's something funky going on in the market, that this isn't the way it should be, because theoretically this should be relatively flat, because that's the indication that that's what the average of the 10-year Treasury is, 4.5 right now. Like, you should be able to hold that for 5 or for 10 years, and that's the rate. It shouldn't just be up, up, and up. So
yeah, but that's just a projection, though. It's like, I'm sure if you looked at the projection for the stock market, I'm sure it'll just be like, oh, it's just going to go up and up and up through inflation.
But Mauricio, this has never been the case. It's never been that you look at the 10-year Treasury. As I said, why would you buy a 10-year Treasury at 4.5 if the projection is in 5 years that it's going to be, 5? If bonds, if the projection is these bonds are going to keep going up in rate, that means the projection is the value of your bonds are going to keep going down.
Right. Well, but you're comparing it to what, though? You're comparing it to me holding cash in dollars, and so how much is the value of my dollar going to go down?
Comparing it just to holding bonds. If you keep holding that bond, the value of your bond is going to keep going down. You won't be able to resell.
If the value of holding my cash is going to go down lower, I'd rather hold it. I'd rather hold Treasury bonds than hold cash if I think cash is going to go down 10%.
So this, though, drives the question: when does the Fed step in and simply revert back to, instead of reducing the balance sheet, buying certain bonds to fix these issues?
I think they're going to do it when these bond auctions don't have enough demand, and they have to do it to keep the long end of the curve in check. But they can only do that.
Could be within weeks. It could be just the next 10 years.
Only do that if they don't have fear of inflation, and that's why we're in a bad spot. It's not interest payments. It's not anything else like that. The reason why nobody thought through, not the United States not growing as fast, but those payments getting high, and the Fed can't step in. So everyone, that's the whole Keynesian thing. This huge, I'm not going to say that, but this huge system of them just literally issuing fake money and buying it in a circle. All of a sudden, you guys, the Fed can't magically step in, because if they do, they drop interest rates, then we have inflation and they kill Main Street. So if there wasn't a risk of inflation, the Fed could just do whatever it wanted theoretically and just always buy. there's no one to tell them no. There's no one to stop anything. And that's where that idea really
I have a question for you. If all of a sudden, and I know this is never going to happen, but hear me out. If all of a sudden Trump came out tomorrow and was like, listen, we tried the tariff thing. It's not going to work. We're going to go back completely free trade. What do you think the 10-year Treasury would end up being the day after?
wouldn't change much.
I completely disagree.
I disagree also.
I think it might even run down to 3.5 if he said that. Just because I think a lot of this, what's is happening, and I'm looking at these curves and everything, is people are concerned that the interest rates are going to be higher for longer. They're going to have to stay this much higher. And because of, as you said, inflation, because of all these different things, and a lot of those things are fear of how the tariffs are going to affect that. And I think we already saw the 10-year Treasury go below 4. Like, we know it can happen. And it's been the fear of tariffs that have been keeping it up, in my opinion.
And here's the crazy thing: you're both right, you're both wrong. This is such a complicated topic, and there's so many variables at play that I could see. If I kind of agree with Kyle on this, but I could 100% see AJ being right and us being wrong for reasons that we can't even conceive of right now. Just market dynamics that play out if some major political decision were made, and that's the whole point here. We can talk theoretical all day, but at the end of the day, I don't think anybody really knows.
No, we don't know, but we do know that tariffs weren't around when we had this problem. So in fact, the opposite, even when we had tariffs for a time, we had it lower than years before. So I don't think that's the driving reason.
Like, how far back are you willing to go, though? You're just picking one point in time. I'm
picked the last 3 years.
I'm saying the market was willing to go below 4 already, and it was fear of tariffs that sent it way up.
I can make a big counter argument that, like, with tariffs, there's going to be a lot less stuff imported into the U.S., which means we're going to have a lot fewer U.S. dollars exported to other countries, which means there's going to be, with tariffs, a lot fewer U.S. dollars in the hands of other central banks to buy our debt, which means tariffs make interest rates go up.
And two, tariffs adversely affect other countries, and so theirs goes down, so people don't want their bonds. But I guess the point is we've already had it without tariffs, and it was higher than they are now. So tariffs being in place haven't changed really here nor there the game.
Well, tariffs have certainly spiked bond yields over the last 2 months.
Yes. You can literally watch an announcement on tariffs and all of a sudden bond yields spike. Like, it obviously affects it.
Anytime there's a little uncertainty, they go up or down. But you take that with anything then, every time the bond yields have spiked over the last 3 years. You see what I'm saying? Like,
but the prevailing narrative is that tariffs are going to equal inflation. Inflation's going to equal higher rates. Higher rates are going to equal higher bond yields.
I mean, that can be the prevailing narrative, but I thought the prevailing narrative was that tariffs are going to send a recession. That would get rid of inflation.
Over the last 3 months, we had a low point at just below 4% for the 10-year, and it was literally the day tariffs went into effect.
Now go back the last 3 years. So all those spikes didn't have anything to do with tariffs. In fact, we're still below the last 2, 3.
They were other things, but tariffs are what's driving this current, or it was just coincidence that we saw bond rates just happen to start going up literally the day tariffs were implemented.
Or they've been listening to Drunk Real Estate and my predictions that I'm going to win the bet with you that inflation will be going back up in the next couple of years before the end of the decade.
Okay, we're 50 minutes into this.
Jay, you think that whenever you give me like the wrap it up thing, that's going to make us go faster? It actually makes me want to talk longer when you do that, because you're so obnoxious with it. Like, you're determining, like, it's, I've had enough, I'm going to do this. Like that's you did it like 8 minutes ago, and so I purposely was like, I'm going to bring this up because I want to talk about this. So like, just like,
I'm just trying to avoid a 2-hour episode.
I know what you're not trying to do. When you're willing to talk about something, like you gave the wrap up signal 8 minutes ago, like you were done talking, and then
I could talk about this topic. I have about 10
you've
more
done
points
half
I
the
could
talking. Since then, you've done half the talking. So what happened is we just got to the point where you had nothing else to say. So then you decided, oh, let's do the wrap it up signal again because I have nothing else to say. So we should wrap this up. So that's what I'm realizing is when Jay has nothing else he wants to talk about, he gives us the wrap it up signal, which makes me like want to talk more about it because
fantastic.
It's
I've got about 2 hours more stuff I can talk about on the bond market. I can talk.
I already ran out of wine, and I'm already switching over to the Woodford Reserve over here because this episode's already going way too long.
Well, okay, it hasn't gone way too long. We're not even an hour into it. Like, come on.
Are we gonna cut the top 10
and the budget? We're going to talk about the budget bill, and it's. I don't know. I don't feel like we have to talk that much about it because let's talk about the stuff that we believe is going to stay in. Because here's the problem: it's passed the House, it hasn't passed the Senate, and I believe most of us are just going to
driver for real estate investors. The bond market's the most important thing,
right? And right now, I think we're all going to kind of have the same opinion that like, what is this? We're adding more to the budget than we already had. We thought fiscal responsibility was going to be one of the things of the administration. But we do have this framework for the one big beautiful bill, and it passed through the House.
Wait a second, I wasn't done talking about bonds.
It extended the tax cuts from the previous Trump administration, increased the defense spending, it increased immigration enforcement, increased the SALT deduction cap, but it did decrease Medicaid support. So if you notice, there was a lot of things increasing in this bill, which it led to the projection that they're going to have $3 trillion added to the deficit over the next 10 years. As I said, it's unclear whether it's going to pass through the Senate, but currently as it stands, there are quite a few concerns. So Jay, I think I got to throw this back to Jay. I know you have trouble criticizing Republican legislation, but I want you to take a crack at this anyway.
I would love conservative legislation, budget legislation. I have a problem with non-conservative. I don't care what side it is. And this is not a conservative budget. So let's start with that. Okay, so we have this House spending bill. Just to start with the most important thing here, this is not legislation yet. This hasn't been signed into law. This was a bill passed by the House last week. It's now gone to the Senate. There's a number of senators, Republican senators, so it looks like none of the Democrat senators are going to vote for the bill at this point. And there are probably at least 3 Republican senators, which is
aren't they just going to pay him off? I guess that's my concern. Like they're just going to literally pay him off with like put something in the bill that's going to appease them and it's going to get passed through. Like I'm looking through the current one and there's some random like no tax on car loans. Like how the does that make it in there? Like what does that have to do with anything?
You have Detroit, lawmakers trying to get their say. That's why it's
exactly.
So
that's my point.
To me, that's so difficult because you have like states where like the SALT thing, for example, right? The whole and not to steal your thunder, Jay, but it's like those affect certain states. Certain pieces of it affect different states, and so you have
those
all these
scream payoffs to me. Like those had nothing to do.
And that's why you end up with this balloon of a thing because everybody gets paid off. And last time I checked, there was 426 people you had to go pay off.
Here's the biggest thing that's going to cause heartburn for a few Republican senators, and that's that there are several.
Even literally. But because Medicaid, that's the heartburn medication.
There are several senators, especially on the Republican side, that have made a career out of criticizing deficit spending, that have made a career out of saying we need to balance the budget, that we need to basically reduce spending and get debt under control. Rand Paul is one, Ron Johnson is another, there are a few others. And so for them, it should seem, I don't know exactly what will happen, obviously, nobody does, but it should seem that raising the debt limit $4 trillion, raising the deficit $350 billion a year over 10 years or $3.5 trillion over the full 10 years is a non-starter. And Rand Paul has come out and said he won't be voting for it. We have to get much closer to a balanced budget. Ron Johnson said the same thing. And Ron Johnson came out and said there are a couple other senators I know of who are on the same boat. So
even much closer, though. Like, why don't we why is this acceptable? I guess I don't get it. Like, we got to get closer to
it's because they know it won't get passed. Politicians always do this. They don't want to be the bad guy. So they're literally the House is like, first of all, they have how long, Jay? What are they, 12 months they can do this? So no matter what they all say, when they have the power and they can get it through, it's payoff time, pay off everybody. But then they can go, and when it doesn't pass in the Senate, guess what they get to say? Hey guys, I tried. It was the Senate. So
yeah. And so right now, I think it's highly, highly, highly unlikely that the current bill is going to pass this. In fact, I would say there's zero chance the current bill is going to pass the Senate. The Senate is going to demand some changes. They're going to pass something that's going to look a whole lot different, especially when it comes to Medicaid. And that's the interesting thing with Medicaid. So the House bill cuts about $800 billion in Medicaid spending. Keep in mind, Medicaid is partially funded by the government, partially funded by the states. This is the federal government's portion of Medicaid that's getting partially cut. The states can either choose to pick up the slack and fund the extra or not. At the end of the day, it's about a 10 to 15% cut overall to Medicaid. Some people are suggesting that to pass the Senate, those cuts need to be deeper, that there are some senators out there that think they're willing to cut Medicaid.
Like that's the issue.
Well, yeah, well, they're willing. They think we need more budget cuts, even if it's at the expense of Medicaid. And there are other people who think that it's just the opposite, that to pass Senate, you'd have to reduce the Medicaid cuts because there are a number of senators who represent states, Republican senators who represent states that have a lot of folks on Medicaid. And so those senators are going to push back to these Medicaid cuts. So we don't even know if the issue here is that the cuts go too far or not far enough. So that's part of the problem. But I think it's highly likely that the current bill is not going to pass in its current form. That said, let's talk about what's in the bill. The next step, again, is the Senate will make their changes, send it back to the House. If the House then agrees with it, it'll go to the president. If the House doesn't, then they'll make their changes and it'll go back and forth as many times as necessary till everybody agrees.
And Jay, can you go quickly through like the stupid shit and so we could focus more on like the tax cuts?
Before you go into the stupid or not the stupid, maybe we can talk a little bit about how it sounds like Trump is, because he's so influential, right, with the party, whether you like it or not, that he's kind of drawn a line in the sand. Like, this is important to him, right? He's like, dude, you got to pass this thing. Otherwise, I'm going to hate your guts and I'm going to basically tell people not to vote for you at the next election. How much of that is going to influence, do you think, the senators and House ultimate decisions?
Not as much as it did last time.
Yeah,
really?
It has seemed that Trump has a lot more.
They hate the wrath of, like, when Trump comes down on you, man. Everybody's put their tail between their legs and they go crying somewhere.
Yeah, but at the same time, if you go against Trump's bill right now and you get something like you're going against it and then they pay you off for something for your constituents, you're probably going to survive the next midterm and you're not going to give it, right? Like,
in theory, like the House and the Senate are co-equal branches and they're equally powerful and they're basically the same in different levels. The reality is, when it comes to dealing with Trump, it's more like the House is the JV team and the Senate is the varsity team. Trump's had a lot more impact on the House with his threats. Elon threatening to spend a lot of money to primary the House members that voted against stuff. And it seems like in the Senate, there tends to be a little bit more resolve, maybe because those guys tend to be longer serving. They have longer terms. And they probably have a lot more money to go out and defend themselves if Trump or his team were to try to badmouth them. So I think there's probably going to be less influence from the administration on the Senate. But who knows? I think that's a very real part of all of this. Okay, so going through, we've got two sides to the bill. We've got the tax cuts, which is somewhere in the $4 trillion range. And then we have the spending changes, which is somewhere in the, 4.5 trillion, somewhere in the 500 billion to $1 billion range on the spending changes. On the spending side, we're increasing military spending by about 150 billion. We're throwing a couple $100 billion into ICE and immigration enforcement, and then cutting Medicaid by about 800 billion, cutting the SNAP program, which is basically food stamps, increasing the debt limit by 4 trillion, which is basically, this is a couple of the senators have thrown out like this idea that, hey, how good of a bill could this be if we have to increase the debt limit by $4 trillion? It basically says we're planning to balloon the deficit and the debt. Another interesting thing in this thing called Trump accounts. So the bill includes a provision for basically any children born between now and 2029 to receive $1,000 into basically a tax deferred account that can grow and be used kind of like a 529 plan. It can be used for
Are they
college.
called Trump accounts or MAGA accounts? Are those two different things?
It's two different. I don't know what MAGA accounts are. This is called Trump accounts.
First of all, that is completely discriminatory against people who've closed down the factory, who can no longer have kids, and I object.
So anyway, so $1,000 tax deferred. It can be, families or other people can contribute to grow those accounts. Then they can be used for college. They can be used for down payments on houses, things like that, when they're in their teens or 20s or 30s or whatever. I actually thought that was interesting. My concern about that is this going to be the first step in trying to replace Social Security? But if this is really just an opportunity to basically encourage family growth and encourage savings for kids that are born in the next few years, I actually like that a lot.
Didn't Obama have some kind of a thing where he was like mandatory 401k accounts or something? And it was like,
it never really went anywhere.
Yeah.
So anyway, so tax cuts, spending changes, increase in the debt limit. Those are the big things. Essentially the CBO, the Congressional Budget Office, which is kind of this independent third party that's part of the government, has essentially said that they expect that this is going to increase the deficit, the entire bill, if it were to pass, by something like $3.5 to $4 trillion over the next 10 years. They've given, I'll throw the chart up. So here's the chart. In 2025, we'll see a savings of about $100 billion. Then next year, it'll cost us an extra $479 billion, an extra $600 billion in 2027, going back down from there. But basically costing us several $100 billion every year for the next 10 years, for a total of somewhere in the $3.5 trillion range. If we were,
by the way, isn't that great news though? I mean, compared to where we're going, I mean, if we could limit our increase in the debt to 4 trillion over the next 10 years, isn't that pretty good?
That's in addition to the 1.8 or $2 trillion that we've already forecasted. So that's in addition to the current.
And that's not factoring in 10 years. We're not going to have any emergencies.
Exactly.
Or wars.
Or just they won't up it again.
Yeah. Because, so this is an extra 400 billion a year on top of the 1.8 or 2 trillion that we're already deficit spending. So we're at somewhere like 2.4 trillion per year in deficit spending.
This is during peacetime, right? There's no
active
wars
during peacetime.
Yeah. So like no recession and no wars.
So let's talk about a few of the things that are likely to stay in the bill. There's also a few things, and I'm not going to cover this because I don't know if they're going to stay. There are a few things that are non-budget items in the bill. Fun fact, the way this process works, the way they're trying to pass this bill through, they actually legally can't put anything in this bill that's not budget related. And there's this independent, unelected person that's part of the Senate called the parliamentarian. And that person's job is basically to make sure that the Senate is doing things legally. If that person, if she sees that there's anything in this bill that's not budget related, she can basically strip it out and say, nope, you're not allowed to have this in there. Then they can vote and overrule her or not overrule her. But long story short,
what's the point of having her if you could just vote to overrule her?
So because you needed a majority to overrule her, and there are a number of senators.
The majority already voted for the bill, though. That's they're already going to vote.
There are a number of senators. So this, I was doing some research on this because that was my first thought when I heard about this a few weeks ago, or when I was thinking about this a few weeks ago. And the reality is there are several senators who are very hardcore on, you don't want to set a precedent of overruling the parliamentarian, because basically the parliamentarian is the person who can really hurt you in the future, and can make your life difficult if you basically they try and overrule it. That said, there was an interesting situation. I think it was under Obama, where the parliamentarian tried to slice something out of a bill. Instead of they couldn't get the votes to vote the thing back into the bill, but they could get enough votes to vote the parliamentarian out, and they brought a new one in. And so that's
like the Tom Cruise stories where he tries to do all these safety things, and he's like, I went to the safety guy and I told him this, and the safety guy said no, so I got another safety guy.
Exactly. So there are some interesting stories there. I don't know all the details, but then there are some things as real estate investors.
Let's talk about the real estate.
Yeah, there's two that stick out to me.
Let's go with the real estate angle.
Okay. So
let's talk about bonus depreciation, for crying out loud.
Yeah, that's one.
So bonus depreciation would come back. It wouldn't come back proactively or retroactively, I should say, to previous years. But
they were talking about retroactive, and I was licking my chops.
Yeah. But bonus depreciation would come back. There would be a good amount of money allocated to LIHTC, so low-income housing tax credits. So for those developers out there that are developing low-income housing,
which we did an episode talking about LIHTC, and it's a mess of a program. So it doesn't matter how much money you give to them; it's not going to fix anything.
Agreed. And then renewing opportunity zone funding. So it would basically bump up funding for opportunity zones. So for any investors out there that are buying in opportunity zones, you'd be re-up there.
I think so. Did you see the amount though? And I think the amount, I wasn't able to find statistics on like how many people took advantage of the opportunity zones. And I don't know if you guys remember back when opportunity zones were first announced, it was mayhem. People were like creating funds immediately. They didn't even know what the rules were, or they didn't know where they're going to be. They were creating funds basically on the idea that opportunity zones were going to happen. There was all this money thrown around. People were going to do this, and this. And then I just kind of get the feeling that it kind of fell a little bit.
Dude, I was in front of this thing, man. When this opportunity zone thing came out, I went to like all the conferences. I wrote papers. I got on panels. I mean, I'm like, this is the next big thing. I'm going to be the go-to guy. And then the thing gets passed, and then crickets. Like, no. And the reason was primarily because for us, especially for the real estate investors, our normal real estate investors, this idea of have to substantially improve the property, which basically you have to like put double the amount of the bases into it, just didn't work for the usual value.
I read it actually a little different than I read it, that people who invest in these types of things, that opportunity zones would be the investment, have gotten so used to faster turnarounds that the idea that when they put out these opportunity zones, that you had to hold it for 10 years. Like I was only involved in one thing that was potentially going to be an opportunity zone. And just the feedback we got is that people don't want to like the 10-year thing.
Because I got like after all that prep, and I'm like, all right, here we go. Like all this business is going to come my way because I'm going to be the opportunity zone guru. And I literally, I think, did one deal. Like I spent all this time and traveled to so many I did like one or two deals, and there just wasn't an appetite for it.
Yeah, it just when I saw this budget, and I saw, like, if you look at all the hundreds of billions set aside for all, and even tens of billions set aside for all these things, it was like, this is 5 billion over 10 years. And it, like, I feel like that just reflects what the appetite was for it. And it's, to me, it's another one of those things, the same as my conclusion on the LIHTC. It's a lot of times it just, you make the deal work conventionally, and if the opportunity zone thing works out, then perfect, that's gravy on top. But you got to make it work conventionally first.
And it really only works if you're a developer. I mean, that's the reality of it. So all of our value add multifamily, or like AJ, probably for you it probably would have worked because you buy something in an opportunity zone and you're building from the ground up, then that you're doubling the basis of the property, so that makes sense. But if you're trying to do even back then, the heavy value adds, the numbers just didn't pencil out.
But even that, like, we have a development that's in an opportunity zone right now, and we're about to get the land, and we're about to start a raise for it, and so we could do
Yeah, but
the
today,
opportunity zone
remember
thing.
today, not to get, I don't want this to be an opportunity zone episode, but like when it came out originally, and I don't know if I don't think they're retroactive in this, but originally it was like a deferment plan. So you could defer for the first 5 to 7 years all of these capital gains, which those already expired, or I think the 7 years expiring this in 2026. So like you don't get that bump up in basis and the deferring. It was almost like a 1031 exchange for the next 5 years. You got to defer your tax.
If you did the 10-year, it was gone.
You get
right?
the 10-year, but that's like you got to hold the investment for 10 years to get the capital gains thing. But there was a lot of like business owners that sold, like, you know, dental practices and law firms that suddenly sold their, or any business that sold their business. They got all this money from the sale. They could put it into one of these opportunity zones and they would defer tax for 5 years, and then they would actually get a step up in basis of anywhere from, I think, 5 to 15%, if I remember correctly.
To me, it was like a very niche person who, like, they were at the end of their investing career. Like, this is they want that
We're
exit.
talking about the budget. Jay, ignore these guys. Keep going.
Thank
That's
you.
part
Oh,
of the budget,
oh,
though.
sorry, we're
Throwing
talking about
money-
something that's
they're
actual
throwing
real
money
estate
to this
involved.
nonsense opportunity zone thing.
Yeah.
Is that in the budget? I'm sorry, Jay. Is opportunity zones? Are we going to expand it? What are we going to do?
So it renews the opportunity zones that were already there.
Oh,
And it says expand it.
It might expand it. I don't know.
All right, okay, so do we talk about, we got bonus depreciation in, right?
But I guess, okay, let's wrap up the opportunity zone though. But I like, my opinion is it's not going to move the needle much. We're not going to see all of a sudden a flurry of opportunity zones. I don't know your guy opinion.
I think it's just standard as
Yeah,
as it
I
has.
don't think it's changing anything. All
All
right.
right, what else affects
So
real
bonus
estate, Jay?
depreciation, LIHTC opportunity zones. It's going to raise the estate tax exempt limit to 15 million per person.
That affects AJ more than it doesn't affect us, but it'll affect
Yeah, it doesn't
AJ.
affect real estate investors.
AJ, how do you feel about that?
I'm very excited.
By
I would-
the way, on the bonus depreciation, does that mean AJ you go out and buy a third plane? Is that what happens, or how does that work? But like seriously, like the idea, I mean, everybody thinks of bonus depreciation in terms of real estate, but like even the cars, or like if you can bonus, because the cool thing about the bonus depreciation, and it's more pronounced when you do vehicles or planes or boats or whatever you're going to do, is that you could literally buy $100,000 or $1 million or a $10 million asset and put like 3% down, right, to finance it, but you get to write off the entire darn
That's what
thing.
Jay did with his G wagons. That's why he has like 9 of them.
That's right. So you buy a $100,000
Jay's got a
G-Wagon.
G wagons out in front of his house. It's like,
Seriously, you put, like, let's say you have $100,000 vehicle, you put down $5,000 to finance it, you get to write off $100,000. $5,000 gets you $100,000 write-off. $50,000 deposit gets you $1 million write-off. It's gargantuous, and it's not just real estate. Anyway, that was my soap opera there. Can we talk about
But theoretically that should, especially but I guess the question is, I wanted to know logistically, like, it's not going to affect this year, right? Because it'll be the budget for next year.
No, I think it's 2025, isn't it?
Is it 2025? So as long as they can pass this.
Yeah, as
then
long
we
as you
will get-
put it into service. Yeah, as long as you place the vehicle, the property, the plane, the yacht, all the stuff that Jay's buying this year into service, you should be good.
So theoretically, this fourth quarter, which is usually when you see the people who need the tax benefits, this fourth quarter, we should see a pretty healthy demand for people to invest in syndications that have bonus depreciation.
but Jay, will the Senate do it? Will they expand? Will they do it retroactively? Has there been any interest in it?
Well, and not to be the wet blanket, but remember last year the House passed the bonus depreciation retroactively, and the Senate couldn't get it together and didn't pass it. So before you get too excited about it, it's not a done.
Yeah, I got the impression retroactively was a pipe dream for us.
And if anybody's wondering, drugs and hookers are not subject to bonus depreciation. I heard. That's what I've been told.
But you know,
But Jay, the tips that you give them though, there's no tax on those. So
No, well, it depends. If you're hiring the good ones that are making over $160,000 a year, they're phased out.
how many people all of a sudden that haven't been making tips are all of a sudden going to be making tips out of the blue this next tax season. It'd be interesting.
So one of the provisions of the bill would be that in the first 90 days after passage of the bill, the administration would define what industries it would apply to. So it wouldn't be not you couldn't say I'm a CEO, I'm going to start getting paid in tips. It would be people that are traditionally, historically paid in cash tips. So people.
Yeah, but I already had this conversation with my hairdresser where I'm like, hey, so once this passed, like, just charge me $5 for the haircut, and I'll give you a $50 tip. You know, like it's like
how much are you paying for haircuts? Jeez.
You don't do $50 haircuts? I mean, it's like 45 and then plus a tip, so 20% tip. I don't know. You guys might be cheap. But.
Can we talk about the stuff that's not in the bill that might be in the bill? Because that was something that popped up on my radar on the syndication world.
Tell me.
Sure.
The carried interest, like the one thing that's not in there, which Trump's been a big supporter of, is this quote unquote carried interest loophole, which basically says that, you know, as syndicators, that 20%, you know, sweat equity, that's called the carried interest, you get taxed if you hold it for a certain amount of time as capital gains instead of ordinary income. And the knock on that for many, many years is that it really benefits mostly, the saying goes, these huge hedge funds, like, you know, all these hedge fund managers and private equity groups that they're just making billions and billions of dollars. These guys get to benefit. So it's kind of a loophole, not only for the rich, it's a loophole for the billionaires is the narrative. But for us syndicate,
well, the big narrative was someone like Elon, right, where he has all these these gains that he hasn't, like, and he just takes a loan off of it, right?
No, that's
a different issue. That's a different issue. This is your 20%. You sold the property. You got 20% of the profits. That gets taxed as capital gains.
His wife doesn't. His wife doesn't let him in on those types of details.
Oh, okay. Sorry. If we can get, yeah, I'm sorry. That's right. I forgot. He's out of the loop.
He gets his $125 a week in allowance and doesn't ask questions.
Sorry, I stepped away to let my dog out. I missed the.
So the loophole essentially, when you sell your property, right, you get your 20% profit, your 30% profit, you're going to pay typically a long-term capital gains on that. So it's like, you know, probably 20% or something. They've always wanted to close that loophole. So now you would actually be getting taxed at ordinary income rates. And that's what, it's not in the bill. It's nowhere to be found on the bill that the House passed, but I've heard a lot of rumblings over the last couple of weeks. That's something on Trump's agenda. So don't be surprised to see the Senate bill introduce that carried interest.
I think he cares more about passing it than getting something like that in, don't you?
He just needs to, like, he doesn't get carried, like he doesn't syndicate. I don't think he's syndicate. He just buys them for his own freaking money. So I don't think it affects him or his buddies. And so he's like, if that's a way to score some political points, because it's not a ton of money. I don't think he's going to be saving on that, but he can score some political points and in exchange for that, get bonus depreciation or something else that does benefit him. Then that's what. But anyway, so carried interest, just keep an eye on that. That might be in the news here in the next couple of weeks.
Yep. Let's see what else. 199A deduction. So for some smaller real estate investors, so a lot of the mom and pop real estate investors out there, they use an S corp to do pass through income for things like flipping and other pass through activities. Back in 2017, this deduction was thrown in, this 20% qualified business income deduction, where if you have a pass-through entity, you basically tax-free on the first 20% of income. That's actually going to be increased. Well, it's proposed to be increased to 23%. So if you have a pass-through entity and you were previously...
That's not professional services. Unfortunately, I don't qualify for that nonsense. But yeah, as long as it's not a professional services business, yeah.
Yep. And then what else? On the bad side, there's this mortgage interest deduction. Used to be that, like, if you buy a house and the equity is up to $1 million, you can deduct your mortgage interest. That got dropped to $750 back in the original bill. That's still at $750. It's not going back up to.
But the SALT deductions went up, though.
The SALT makes a big difference. Yeah.
State and local taxes. So for anybody that's in a high tax state, property tax state, like California, if your mortgage interest
doesn't even have to be high tax. Like it used to be, the cap was 10,000.
10 grand. Yeah, it's going up to 40, right, on the House bill.
It's going up to 40. I've got a few friends in California, Mauricio, who are still not very happy with 40.
Dude, it doesn't make a huge difference. Like, I'm actually looking into buying a home, and so it's like, okay, great. So the delta between 10,000 and 40,000 is 30,000, your federal tax, it's like
But like
10 grand. I'm saving
even
10
in my
grand.
area, in the nice areas, like for a $600,000 home, taxes could be almost 10,000. So it's like that's not that much.
Yeah, it's not a huge difference. And remember, it's not a credit, it's just a deduction. So you got to take your federal income rate. So let's say it's a third, then on a delta of 30 grand, I'm saving 10 grand. I mean, it's nice. Don't get me wrong, I'll take it.
How about in states like yours, Jay, that's really you don't have an income tax, so the real estate tax is that, you think that's going to make a difference in like Texas, Florida, or do you think it'll be
What's that again? The salt
I mean,
tax?
if their other taxes are much higher because of it, yeah. But if you're, Texas, if you're getting your income from, oil, then I don't necessarily think it'll be.
No, but I think to AJ's point, like Texas is, I don't know what it is in Florida, but Texas's property tax is like 3%. It's like pretty high. But
Well, our governor here in Florida is proposing no property tax and no income tax. So money's just going to magically appear from somewhere.
I'm coming to Florida. Okay. All right. I'll see you soon, Jay. Thanks.
Temporarily until the place, until
Sales tax is going up to 73%, I guess.
they got to start taxing insurance, and then they'll
by the
solve
border
everything.
and go to Costco over in another state. And then
Exactly.
All
Exactly.
right. Anything else, Jay, in there that we should care about?
That's the big stuff. I suspect that we
What
will
about
still be
the $4 trillion that we're going into debt over?
Yeah, so the debt again, debt limit increase of $4 trillion. This is actually worth spending a few seconds on. So basically, we've reached the debt limit. This country is not allowed to borrow any new money. So right now, we are operating off of the cash that's coming in through tax receipts. IRS is collecting a lot of money in taxes from people, and we're using that to fund the government. If we run out of cash in the Treasury, we can't issue any new debt right now because we've hit the ceiling on how much we can legally borrow. And depending on who you listen to and what math they're doing, sometime between June and August, we will run out of money if we don't raise that debt limit. And we've had an episode on that, so you can probably go back and find it.
Because has it ever happened in the history of the United States where we'd had to raise the debt limit before?
Yeah, I think it's 12 times over the last 15
it's like
years.
Every time. It's like there's no real debt limit. It's just every time the number comes up, it's just a bunch of negotiations and back and forth. Like
As we said last time, it's just it's a reason to get political and for people to get agendas passed.
So normally, though, those need to be passed at 60 votes in the Senate.
Unless you do reconciliation.
Reconciliation, which this bill is reconciliation. That's why we have a lot of rules around. You can only have budget items in this bill, which means we only need 50 votes to get the debt limit in this bill. It's part of the reason, actually, why they've done the bill the way they did, because they were concerned that they wouldn't be able to get the debt limit raised if they did a separate bill that required 60 votes. So that's the reason it was thrown into this bill. And it is one of the reasons why this bill, I don't want to say has to pass, but eventually either this bill or something similar is going to have to pass, probably by August at the very latest.
Can't they just do a temporary bill to raise the limit that's so only good for 6 months? And
they can. It's just a question of, are Democrats going to be willing to risk the entire economy by not voting to increase the limit?
Not to risk the entire economy, to risk the re-election campaigns.
Exactly.
Well, I mean, they're doing both. If we don't raise the debt limit, that's the economy. And at some point, we have to stop making payments on even things like interest on the debt. And so you are putting the economy at risk. Whether the Democrats would do that, neither side has been willing to do that in history. So I think it's unlikely, but it could definitely be negotiating leverage for the Democrats if the Republicans can't pass this bill.
The problem, though, midterms on this, whether it's the debt limit, it like this always happens, right? You have Congress, they come up, if they don't get their state and their constituents all that sweet tax money, they're going to kick them out in midterms.
Yeah.
So then when they all go to the table, all these mouths need to get fed, and they're going to do whatever it takes to keep their job. And so then all Republicans are like, hey, we're going to kick this down the road and somebody else's problem. I want to get reelected because they're all scared about not getting reelected because that's how it works. They're not going to keep the House. They never do. Whoever's in power, they lose the House. And so
the crazy thing is, normally what would happen is the Democrats would say, we're not going to vote for the debt limit increase unless you give us what we want. Well, what do you want? We want you to spend a whole lot more money on people and spend a whole lot more of our tax dollars and raise the deficit even more. And normally Republicans are like, no, we're not going to do that. Well, this time Democrats are going to say, we're not going to pass the debt limit unless you're willing to spend a whole lot more money. And Republicans are probably going to say, great, let's do it.
As a reminder, though, I just want to remind something. I thought it was fascinating. I don't know if you guys remember the last time. It wasn't Trump, but remember the last time they were trying to repeal and replace Obamacare after Obama left the country. They had the House, they had the Senate. Republicans had the House, they had the Senate, they had the presidency, and they just couldn't get it. They couldn't, even though everybody was against this particular bill. Everybody wanted to get rid of Obamacare. They couldn't get the votes on both the House and the Senate. So don't think for 1 second this is absolutely going to pass the way they want it, because even when you have all three branches of government,
well, it's so close, right? But theoretically, with reconciliation, they don't need any Democrats.
So many special interests involved.
But the reason the repealing Obamacare didn't pass is because a lot of these senators, even the Republican ones, especially the Republican ones, are representing states where a whole lot of their constituents rely on these federal services like Obamacare, like SNAP, like Medicaid. And
you mentioned the senators who are conservative, Senator Paul Rand Paul and others. They're like, we can't. It's going to increase $4 trillion. We're on principle, we're not doing it. So now you've lost 2 senators. You don't have that much more room, if any, to spare.
No, you lose 2. I think that's their cushion. They lose 2 and they're done.
They can lose 3.
Yeah, the Senate, though, they've already had 5 come out. So that as far as the Senate goes, they've already got the votes to stop it. That's done. They've already have Republicans that have gone up against it. But I guess the question then is, what are they going to get for it? Yep.
Yeah, but how? Yeah, exactly. Like how much? What is it going to take to get bought off? Not bought off, but like what special thing you're going to have to add for their jurisdiction to make it happen, right?
Yep. So anyway, that's. I have a feeling we're going to have another segment on this particular topic at some point in the next month or 2 or 3.
So walk us through the time frame. What's that look like, Jay?
There's no time frame. So Trump has said he wants to pass this bill by July 4th. That's his goal. So what's that put us at? That puts us at a little over a month, maybe 5 weeks.
Which is so dumb, because then they're going to get together the week before and figure it out. But
none of these people have even read it. You listen to these Congress talk; they don't even
they don't pay attention until there's a deadline, and then they work overnight for 3 days right up until the deadline. Like,
they have a bunch of aides tell them what was in it.
Well, but now this is something I thought, because I remember that the famous Nancy Pelosi quote that we got to pass the bill to figure out what was in it. Now you got ChatGPT, man. You could just upload that sucker, although it's got a page limit. So I don't know if you can upload 8,000 pages, but there's got to be some version of ChatGPT that they can throw in there.
I'm sure DeepSeek will do it better than ChatGPT, right? We should be putting the
all government documents in
all the government documents in the Chinese AI, right?
So you don't have to. The bill is actually, you can just go to the congress.gov and look at the bill. So in theory, you could probably just feed the URL into ChatGPT. I hadn't tried it, but I'm guessing you could probably just feed the.
Yeah, I've tried that before.
I wonder what happens if you feed it in and you say, "Is this a good bill?" See how it skews. We good to move on?
Let's do it. Would you? We're skipping the top 10. So would you rather, or do you have any good ones?
No, I got a top 10. Actually, it's real estate related, because
this is still the real estate, the drunk real estate pod, right?
Yeah.
Okay.
What are you trying to say, Jay? What do you got?
I just want to make sure.
So for anybody that's actually watching, I just fed it into ChatGPT, and here are the key provisions, the potential benefits, tax relief, fiscal responsibility, simplified tax code.
Is it but is it reading from the actual thing you gave it, or is it just reading from the internet summaries?
It's reading from the internet for sure.
Yeah.
Learn how to use ChatGPT, Jay. You don't just throw things at it, man. You got to prompt it right.
One thing I think, Jay, before we end, the 2 topics we had today are connected. And I think it's really important that we realize this. when the government does stupid things, like they just don't think about anything outside what they immediately want, and and they take on debt for today, not worrying about tomorrow. We have today problems that occur. And I think it comes to when does it end? Well, it's a combination of a few things, but this is a major driver. As in, at some point, people start to go, it's out of control. And
well, that's literally Moody's. I know we can brush off Moody's, but Moody's basically, it seemed like they just waited until this budget was passed and said, well, even the fiscally responsible, quote unquote, Republicans aren't going to fix it. So we got issues.
All right.
Top apartments.com. They did the top cities. So I'll do 5 and 5. Top 5 cities with the most renter and the top 5 cities with the most homeowners. So first, I'll let you guys just guess on the most renters. I'm sure you could rattle up the top 5 off the top of your head. Go, Mauricio, say one.
The top 5
percentage of renters versus percentage of homeowners.
Renters are like 45, 50%.
LA.
Right?
LA's one.
San Francisco,
New York,
another one.
Miami,
Chicago,
Miami. And so you got 4 of the top 5.
Boston.
You might not get the 5th. There you go. Boston, number 5. So here's the list. Miami, 73% renter. New York, 71% renter. Boston, 69% renter. San Francisco, 67%. And Los Angeles, 65%. Now, the other side is a little more interesting to me. Top cities with the most homeowners. So any guesses on that? If you get one, I'll give you points.
I mean, how big of a city? Like,
pretty big.
Okay,
Baltimore.
pretty big. So
Connecticut. What's the place in Connecticut? Hartford,
Boise,
Connecticut.
like,
What are the Connecticut places?
Nothing in Connecticut.
Phoenix.
There you go. So it's actually Mesa, Arizona, the suburb of Phoenix. 63% was number 1. So Jay, kudos to you.
Baltimore. Is Baltimore on there?
No. So then I'll list them off. So Mesa, as I said, was number 1, 63%. Albuquerque, New Mexico, 57%. Colorado Springs, 59%. Louisville, Kentucky, 58%. And this one was kind of surprising to me. El Paso, Texas, 58% homeowners, right on the border. That was weird to me. I thought it'd be a little bit more transient right there, but there you go. Those are the top renter cities. Any hypotheticals, Jay, for us? Or are we gonna wrap this up?
Let's wrap it up.
Nothing, really.
I didn't look. I didn't have time. Well, I did have time. I just forgot. I'm looking on Reddit now. The top post is you get $200 a day, but you have to eat 12 bananas every 24 hours.
200.
Let's make it $5,000 a day. $5,000 a day, but you have to eat 12
bananas is a lot.
10,000 a day.
What size bananas are we talking about? Large, small?
10,000 a day. So basically, that's a job to eat 12 bananas a day. I'm doing that.
Wait, $10,000 a day?
What's the number?
I mean, let's just put it in perspective. $1,000 a day is $365,000 a year to eat bananas. Yeah, I will do that. I will.
But you also have to think that's
easy. But you go 60 days.
You might die too. Too much potassium. You can get potassium poisoning.
I was just going to say that's 1,000 calories. I think a banana's got 100 calories
and a lot of potassium. You got to be careful with the potassium.
Okay, here's a hypothetical. $5,000 a day for every day that you spend at least 6 hours out on a street corner begging for money.
How much a day did you say?
5,000.
Do they have to be consecutive or just randomly?
The days?
Yeah.
That's like $1.3 million to go beg on the street
every day, 6 hours a day.
That's what I'm saying. Does it have to be consecutive, or could I just once a month go out and do it?
You can do it once a month.
Oh, once a month? Yeah, I'll do it once a month.
Yeah, I'd do it for once a month for sure. I put on a whole outfit.
You only get 5,000 that day.
Right.
That could work. I could work on spreadsheets while I'm sitting on the corner on my laptop, though, right?
I would go once a week for sure.
Really?
6 hours? That's not that's a work day.
Oh my God! Like
6 a.m. to noon. 6 a.m. to noon.
I don't like asking people for money. Like when it comes to like raising capital, let alone standing on a street corner and
you just hold up a sign that says, I
get all dressed up. I'd put on a fake beard, and no one would know it was me.
Sounds horrendous.
Unless you got to put up a sign saying me, then with my driver's license, this is me. All right.
Couldn't make it in the NHL. Please help.
Yeah, exactly. And show money ran out.
Need to get my nose and my teeth fixed. Please help.
Go read Theo Fleury's book. It happens. Mauricio, plugs. What do you got?
The DRE Daily, an amazing daily newsletter put on by the entire team here at Drunk Real Estate. We all contribute massively. Forget 6 hours a day minimum working on this thing to get it out.
DRE Daily though takes holidays, so just so you guys know, just don't be holding your breath.
Economics headlines. There are no economic headlines on holidays.
AJ, what do you got?
You know what? Check out the YouTube. Alex is still doing an awesome job, so I'm sticking with that. Actually, no, I can't. What am I thinking? On the 3rd, we're doing a big industry update for the self-storage industry. This coming, I think it's on the 3rd. So we'll put the link down below, but we're doing a big webinar that's going over a ton of stuff for the self-storage industry.
That was a nice way to get 2 plugs in there.
I was going to say the exact same thing. That's a slick way of like, I'm going to promote X.
Right under there.
Promote Y instead. Wait, I almost forgot Z.
Jay, you got a webinar or anything you want to plug?
Yeah. So we haven't done a big deal that we've led in about 3 years because, we just haven't found any that we really like. But we finally found one that we're willing to put a lot of our money in, and we're going to be raising for it. So anybody that's interested in learning more about an upcoming ground-up development opportunity that we have in Texas. So we're going to be building 351 units in Texas, in the Dallas metro area. If you want to learn about the opportunity, it's accredited investors only. I'm going to put a link in the YouTube description, or you can go to jscott.com, and there'll be a link there to register for our investor presentation, which will be next Wednesday evening.
Check it out. Excellent underwriting on that, by the way.
Excellent underwriting.
Yeah.
That's a dual. You can't plug anything else. That's a dual plug. You can't. That's it. Like AJ plugged 2 things. You guys plug 1, and we move on.
Well, no, I got to get my own plug. I got to plug my wife. Come on.
He's the moderator. He can do anything he wants.
Yeah, exactly.
He needs to get his allowance, man. He's got a plug. He
needs his $125 a week.
Are we all back? We back next week?
We are.
No, we're not. I don't think we are.
We have to figure out next week. So Mauricio and I are traveling.
Jay and I are going to be at an event together next week.
You skip another one?
We're going to be traveling, so it'll be challenging.
Maybe you guys just post like you do a little like vlog. YouTube vlog of your time or something.
Mauricio and I will do an episode next week, just the 2 of us.
Yeah, when we're in Cabo.
All the fun stuff. I want you riding bikes and the ones with the little baskets through the woods and
look, we're never going to get to 100, are we?
Yeah, welcome to our vlog, guys. This is me waking up. Here's my skincare routine in the morning.
They have a great scooter. Jay, you and I should do the episode on a scooter next to each other, like just going through the downtown and scooters. They have a ton of scooters.
You can do it while eating sushi.
Jay, you seem like a morning and nighttime routine guy too. Like you wake up in the morning, you got a little routine, even in a hotel room.
I have no routine. Like I put off taking a shower and doing anything until the last minute. Like any of you guys that have ever been on a Zoom call with me know that like a half hour before my first meeting with a real person is when I say, I got to go jump in the shower. So I have no morning routine.
Long showers too. Half hour before. Jeez,
it's the hair. It's the hair.
What else are you doing in the shower there, Jay? All right. So we'll see you next week. We'll see. Maybe some of us, maybe half of us, maybe all of us, maybe none of us.
But if not next week, we will all be back the following week.
Yep. And so in 2 weeks, I will see you that Thursday.
See you guys.